welcome to Griffonomics.
Hmm.
Imagine taking out a $10,000 personal loan.
Right. Pretty standard.
Yeah. But the bank that issued it to you, they immediately turn around and loan a third-party buyer $9,000, just so that third party has enough cash to buy your loan from them.
I mean, that sounds a bit like a shell game, frankly.
Right. Well, that exact scenario is what aggressive short sellers are accusing today's subject of executing. But here's the catch. While those accusations are flying, this same company is simultaneously posting, record-breaking billion-dollar heavily audited profits.
Yeah, it is the ultimate high-reward, high-volatility dichotomy. I mean, you have a company posting undeniable top-line growth, but it's colliding head-on with intense market skepticism about the accounting mechanics happening under the hood.
Exactly. And the company at the center of this storm is SoFi. Now, if you only remember them as that, niche student lender from a decade ago, you are in for a serious update.
Oh, absolutely. They're completely different now.
Yeah. So our mission for today's deep dive is to analyze SoFi's fundamental transformation into a diversified digital banking powerhouse. And to do that, we have gathered a massive stack of sources for you.
We've got a lot of ground to cover.
We really do. We are pulling from their 2025 annual financial performance report, recent earnings call transcripts, their 10-K filings, and press releases detailing major partnerships like the one with United Airlines. And, well, because we need the full picture, we're also digging into that highly critical Muddy Waters short report.
Yeah, and we are going to impartially examine both the bull and the bear cases today. We really need to look at exactly how their engine runs and, frankly, where the potential leaks might be.
Okay, let's unpack this. Before we get to the record-breaking numbers on the 2025 scoreboard, we have to understand the business model.
Right, the actual foundation.
Exactly.
Yep.
So SoFi operates what they call a one-stop shop digital ecosystem, and it is built on three main segments. First, you have lending, so originating personal, student, and home loans.
Pretty traditional stuff there.
Right. Second is financial services, think checking accounts, investing, credit cards. And third, you have the technology platform, which includes Galileo and Technisys operating as their the business-to-business infrastructure.
Yeah, and the magic really happens when those three distinct segments interact. I mean, SoFi relies on a concept they call the Financial Services Productivity Loop, or the FSPL.
The FFPL.
Right. And to understand why this matters, we just need to look at a specific data point from their Q4 2025 report. 40% of all new products were opened by existing members.
Wait, 40%?
Yeah, 40%.
That is a staggering cross-buy rate in financial services.
It really is. I mean, the entire mechanism is designed to tackle the two hardest metrics in banking. Lowering the customer acquisition cost, the CAC, while simultaneously increasing the lifetime value, or LTV, of that member.
I actually like to think of this productivity loop like a tech hardware ecosystem.
Oh, how so?
Well, you buy a certain brand's smartphone because, well, you need a phone. But the user experience is so seamless that 6 months later, you're buying their smartwatch. A year later, you're buying their tablet.
And suddenly you are totally locked in.
Exactly. You are completely locked into their ecosystem. SoFi is doing that, but applying it to your personal finances. You come in because you need to refinance a student loan. You realize the app is incredibly intuitive, so you figure, why not open a high-yield checking account? Then, you start using their automated investing tool to buy index funds.
Yeah, and if we connect this to the bigger picture, you can see exactly why legacy financial institutions are terrified of this model. I mean,
Right.
Traditional banks usually have intensely siloed departments.
Right, because of all the historical mergers.
Exactly. They grew through decades of mergers. Their legacy mainframe for the mortgage department literally cannot talk to the database for the checking account department. And they certainly don't talk to the wealth management team. It is a disjointed, frustrating user experience.
Yeah, you have to log into 3 different portals just to see your own money. It's the worst.
Precisely. So by integrating everything into one cohesive digital-first app natively, SoFi isn't just cross-selling, they are building a massive structural moat.
That makes sense.
They only have to pay that expensive customer acquisition cost once, say a few $100s to get you to open a loan. After that, the checking account and the credit card you adopt are essentially high-margin gravy.
It makes total sense on paper. But keeping that productivity loop spinning requires fuel, right? And to scale, they needed incredibly cheap fuel. But wait, I have to stop you there. This brings us to their massive strategic pivot in 2022.
the bank charter.
Yes, acquiring a national bank charter. Now, everyone in the nimble fintech space spent the last 10 years running entirely away from bank charters to avoid the Federal Reserve's red tape. Why would SoFi willingly put their head in that regulatory guillotine? Isn't taking on all that compliance scrutiny a terrible idea for a tech company?
You know, it seems counterintuitive, but it actually became their superpower. It all comes down to the fundamental cost of money.
Okay, explain that.
Well, before securing that national bank charter, SoFi had to fund all of those loans primarily using warehouse lines of credit or the securitization markets, which is really just a fancy way of saying they were essentially renting money from other bigger institutions at a massive premium.
Right, which eats into their margins.
Exactly. The bank charter changed the math entirely. It allowed SoFi to take in direct member deposits, your checking and savings account balances, and legally use those deposits to fund their lending operations. By the end of 2025, they had amassed $37.5 billion in member deposits.
Wow. So instead of borrowing from Wall Street, they are borrowing from their own users. How much does that actually save them?
The savings are astronomical. In the fourth quarter of 2025 alone, the average rate SoFi paid on those user deposits was 181 basis points lower than what they would have paid on warehouse facilities.
Okay, for anyone not fluent in Wall Street jargon,
Yes.
181 basis points is just 1.81%, right?
Correct. And while 1.81% sounds small when you apply it to billions of dollars, it translates to approximately $680 million in annualized interest expense savings.
That is wild.
Yeah, so to answer your question about the red tape taking on the regulatory burden of a bank charter is entirely worth it when it hands you a nearly $700 million structural cost advantage over your non-bank fintech competitors.
That is a staggering amount of found money. And what the sources show is that this cheap capital fuels their fee-based pivot. SoFi didn't just grow their balance sheet, they structurally shifted how they make money. In 2025, their financial services segment achieved an 88% revenue growth.
That's huge.
It really is. It flipped from historical operating losses to generating a massive $792.9 million in contribution profit.
And a huge driver of that specific profit is their loan platform business, or the LPB, which generated $575.9 million last year alone.
This is where that toll booth metaphor comes in, right?
Yeah, exactly.
Because instead of putting every single loan on their own balance sheet and taking all the credit risk if the borrower defaults, they originate loans for third parties. They find a borrower that fits a partner's credit criteria, process the paperwork, and hand the loan off. SoFi just takes a fee.
Exactly. They act as the toll booth rather than the highway. I mean, they don't have to pay for the asphalt. They don't have to fix the potholes if a loan defaults. They just lift the gate, let the capital pass through to third-party buyers, and collect a premium fee. It is a capital-light, incredibly high-return revenue stream.
Okay, so if you combine the cost savings of the bank charter with the toll booth revenue, the obvious question is, are they burning all that cash on marketing, or is it actually dropping to the bottom line?
Right, the ultimate startup question.
Because when you look at the 2025 scoreboard, the scale they reached is impossible to ignore. In the fourth quarter, for the first time in their history, they surpassed $1 billion in quarterly adjusted net revenue. That is a 37% year-over-year increase.
And it wasn't just top-line vanity metrics either. It was bottom-line profit.
Yeah, Q4 marked their 9th consecutive quarter of GAAP profitability.
And let's pause on that term, GAAP profitability, because it is crucial. GAAP stands for Generally Accepted Accounting Principles. It is the strictest, most conservative way to measure a company's earnings, accounting for all the ugly costs like stock-based compensation and depreciation.
The real numbers, basically.
Yeah, exactly. What's fascinating here is how incredibly rare sustained GAAP profitability is in the modern fintech space. I mean, you're so conditioned to the growth at all costs startup narrative, where a company burns through venture capital for a decade, pitching adjusted metrics and hoping to eventually turn a real profit.
Right, the classic, we lose money on every transaction but make it up in volume joke.
Exactly. SoFi has completely shifted that narrative. They're delivering compounding 30+% revenue growth while simultaneously printing real GAAP-certified net income, $174 million in Q4, and $481.3 million for the full year.
It's impressive.
It is. And look at their tangible book value.
Which is essentially what the company would be worth if you sold off all the assets and paid off all the liabilities today, right? The liquidation value.
Spot on. It is a key metric for valuing banks. Their tangible book value grew by over $4 billion in 2025 to reach $8.9 billion, or $7.01 per share.
Wow.
Now, that was heavily aided by $3.2 billion in new equity capital they raised, which we absolutely must discuss later regarding shareholder dilution. But the reality is, a fortress balance sheet is undeniably taking shape.
But here's the thing. They aren't just acting like a traditional boring bank padding a balance sheet. Here's where it gets really interesting. They are leveraging that national bank charter and their proprietary tech stack to push into frontiers that legacy banks are frankly too terrified to touch.
Oh, you mean the crypto initiative?
Yes, case in point, bank-grade crypto. In late 2025, SoFi launched SoFi Crypto, making them the first and only nationally chartered FDIC-insured bank to offer direct consumer crypto trading natively in their app.
And they pushed the envelope even further than that. They launched SoFi USD, their own stablecoin, on a public blockchain.
A federally regulated bank issuing a cryptocurrency. I mean, those two things historically do not belong in the same sentence.
No, they don't. And it is a massive distinction for you as the listener to grasp. In the crypto world, the financial backing of stablecoins has historically been a complete black box of obscure commercial paper and unregulated assets.
Right, nobody really knows what's holding it up.
Exactly. But by issuing a stablecoin directly from a regulated national bank, where the reserves are sitting one-to-one in cash at a Federal Reserve master account, SoFi is essentially trying to legitimize and institutionalize digital money movement.
And while they are doing that, they're also deploying over 40 artificial intelligence proof of concepts across their business. The sources note they are actively using AI to reduce operational costs and automate complex fraud detection.
Yeah, and it all ties back to that third segment we mentioned at the start, the technology platform Galileo. It isn't just internal plumbing for SoFi's own app. They are actually powering major consumer brands.
Oh, right, the United Airlines partnership. This blew my mind. They launched the United Airlines Mileage Plus debit rewards card, and it is powered entirely by SoFi's Galileo platform.
Yeah, it's a really unique product.
It lets users earn miles, not just on the money they spend, but on the money they save. If you hold a high enough daily balance in the account, you can earn up to 70,000 airline miles a year just by letting your cash sit there. It completely blurs the line between a traditional checking account and a high-tier travel rewards program.
It perfectly illustrates the power of owning your own vertically integrated tech stack. When you aren't reliant on clunky, third-party legacy banking software, you can spin up entirely new, innovative financial products with massive enterprise partners in a matter of months, not years.
Okay, so with record billion-dollar revenues, sustained GAAP profitability, and cutting-edge tech innovation, the bull case looks virtually flawless. But our mission here is to make you truly well-informed.
Right. We have to look at the whole picture.
Exactly. To do that, we have to flip the coin and look at the shadows. We need to tear this flawless bull case down and examine the aggressive market skepticism, specifically the Muddy Waters short report. Now, I want to make it abundantly clear to you listening, we are completely impartial here.
Absolutely.
We are not taking a side. Our job is to report the conflicting viewpoints contained in our sources so you thoroughly understand the bear argument.
And the bear argument from Muddy Waters is severe. The core allegation is that SoFi is running what the short seller calls a financial engineering treadmill. They claim that SoFi's 2025 Adjusted EBITDA, which is an earnings metric that strips out certain expenses, is artificially inflated by approximately $950 million.
Nearly $1 billion in alleged artificial inflation. How are they supposedly doing that?
Well, to understand this, we need an ELI 5 on the mechanics of fair value accounting.
Okay, explain it like I'm 5.
In simple terms, traditional accounting usually keeps a loan on a bank's books at the exact value it was originated for. But fair value accounting allows a bank to mark the value of that loan up or down on their balance sheet based on what they estimate it is worth in the open market today, factoring in things like shifting interest rates.
So let me get this straight. If I loan you $100, but interest rates move in my favor, I can suddenly say that loan is now worth $105. And I get to book that $5 profit on my earnings report right now, even though you haven't paid me back yet.
Exactly. You recognize the gain immediately.
Yeah.
Which sounds reasonable in theory if the market actually agrees with your valuation.
Right.
But Muddy Waters alleges SoFi is abusing this rule. They claim SoFi is applying highly aggressive, overly optimistic fair value marks to their personal loans, specifically to front-load their revenue, artificially boosting their current earnings to please Wall Street.
Wow.
Yeah. And they also allege SoFi is engaging in late-stage sales of delinquent loans to third parties just to avoid taking the official charge-off hit on their own books.
Which brings us to the most complex part of the report, the circular financing allegation. I read this section 3 times. The report claims that SoFi is actively lending third-party buyers 80 to 90% of the capital needed to purchase SoFi's own personal loans. And they are supposedly doing this at below-market interest rates. So essentially, they are financing the purchase of their own assets. Why would a buyer agree to this? And more importantly, how does that benefit SoFi?
It all comes down to capital velocity. SoFi's hypergrowth model requires them to constantly originate new loans. But they can't hold them all. They need to move them off the balance sheet to free up room to make more loans.
Oh, I see.
By offering incredibly cheap financing to a third-party buyer, they incentivize that buyer to take the loans off SoFi's hands. The allegation is that SoFi accepts a lower interest rate on the financing just to recognize the gain on the loan sale today. On top of this, Muddy Waters claims they identified at least $312 million in unreported off-balance sheet borrowings tied to these structures.
That is heavy.
It is. This raises an important question about the fundamental tension between aggressive corporate growth and transparent financial reporting. Now, SoFi vehemently denies these claims. They state on the record that their accounting is strictly audited by top-tier firms and fully compliant with all regulatory standards.
Right.
But the sheer complexity of fair value accounting combined with these complex whole loan sales creates a level of opacity that short sellers like Muddy Waters are eager to exploit. When a business model requires constant capital velocity, the methods used to achieve that velocity will always be under a microscope.
And look, even if you entirely discount the short report, if you toss it in the bin and take SoFi's accounting completely at face value, there are undeniable macro and structural risks built into this hypergrowth model, which leads me to a major pushback I have regarding their equity raises.
The dilution issue.
Exactly. If SoFi is generating over $1 billion a quarter, and they just celebrated their 9th straight quarter of GAAP profitability, why do they need to dilute their own shareholders by 13.7% in 2025 just to raise more cash?
That's a very common question right now.
They raised $3.18 billion in common stock offerings in the second half of the year alone. If you are a retail investor holding this stock, that dilution overhang directly eats into your per-share value. Why dilute if you are swimming in cash?
It is a totally valid critique, and one the market reacted heavily to. Management's explanation is twofold. First, they claim these raises were opportunistic. They used the massive influx of capital to aggressively pay down higher-cost corporate debt, which immediately improves future profit margins.
Okay, that makes sense.
But the second reason is structural. As a heavily regulated national bank, SoFi has strict regulatory capital requirements.
Right, the dreaded Tier 1 capital metric the Federal Reserve monitors. For those not deep in bank regulations, what exactly is Tier 1 capital and why does the Fed care?
Think of Tier 1 capital as a bank's financial shock absorber. It is the core equity money the bank holds to absorb unexpected losses. As SoFi's balance sheet grows, and remember, they added over $11 billion in new member deposits in 2025, the regulators require them to maintain a proportional amount of that shock absorber capital to protect the depositors.
Oh, okay.
Growing a bank quickly requires an immense amount of capital retention to satisfy the OCC and the Fed.
And they desperately need that shock absorber because at their core, they are ultimately a consumer lender with real credit sensitivity. I mean, their personal loan net charge-off rate currently sits at 2.80%.
Right.
While management says the default rate is perfectly in line with their pricing models, their entire business is highly vulnerable to macroeconomic downturns. If we hit a recession tomorrow and their core demographic experiences sudden job losses, those default rates will spike.
Absolutely.
If that happens, the fair value of their entire loan portfolio will plummet. Plus, by stepping into the crypto and stablecoin space, they are inviting intense regulatory flux. The Fed, the OCC, and the Consumer Financial Protection Bureau are all watching their digital asset initiatives like hawks.
Which brings us to the final strategic outlook. Based on a synthesis of all our sources, SoFi must be rated as a classic high-reward, high-volatility play. On the reward side, management is targeting incredibly ambitious 38 to 42% compounded earnings per share growth all the way through 2028.
That's massive.
It is. And they undeniably have the deposit base, the integrated tech stack, and the member loyalty to achieve it. But realizing that massive bull case is entirely contingent on the company successfully rebutting these severe accounting allegations, managing their credit risk through unpredictable economic cycles, and navigating an incredibly complex regulatory environment without tripping any wires.
So what does this all mean for you?
Yeah.
It ultimately comes down to how you weigh the conflicting evidence. Do you look at a company boasting a fortress balance sheet, a highly engaged member base driving down acquisition costs, and rapid industry-leading technological innovation? Or do you look at the 13% dilution of shares, the vulnerability to interest rate hikes, and the deep opacity of the financial engineering claims, and decide the risk is just too high?
I will leave you with this final thought to mull over. SoFi is proving right now at a massive scale that the financial services productivity loop actually works. They're successfully cross-selling loans, checking accounts, crypto, and credit cards in a single frictionless ecosystem. If they continue to capture market share at this breakneck pace, will legacy siloed banks be forced to completely tear down and restructure their century-old business models just to survive? Or, conversely, will regulatory bodies eventually decide that the systemic risk is simply too high and crack down on nimble fintechs trying to be everything to everyone?
It is a structural collision course, and we will be watching closely to see who blinks first. Risk defined, portfolio protected.